Hi everyone, welcome to the podcast. I'm Dragan and today we will be discussing strategies, and we have Amanda. Amanda?
Hi, thank you for having me again.
Thanks for coming on. It's Amanda, strategies.
Yeah, this is one of my favourite topics because property investing has so many different, avenues towards success, and there are just as many avenues as there are investors, right? Because every investor comes from a different background, with a different risk tolerance, with a different deposit size, with a different preference. Some investors like to invest in the city they live in. Some investors are really happy to follow the numbers and invest wherever it makes sense.
Mm-hmm. Okay.
So this topic is great because we really get to drill down into what motivates different investors to choose different strategy.
For sure. So we're going to be discussing three different types.
Three different types, so three different umbrella terms. And then within those, obviously, we can zoom in even further. Yeah. And that's, I think, what makes this really great, because as buyer's agents, we meet so many different people and have to tailor our advice to what their needs are rather than try and jam them into a one-size-fits-all strategy.
That's right.
So today what we're going to share with our listeners is the umbrella strategies that we start with, and then the different forks in the road that we come to as we determine the best strategy for people.
For sure.
So broadly speaking, when we say there are three strategies, what we mean is, I suppose, there are three approaches to property investing based largely on not just risk tolerance, but what the investor is trying to achieve.
Welcome to the Passive with Property podcast, hosted by Dragan and co-host Amanda Calabria. With over 2 decades of property investing, Dragan is a qualified property investment advisor and buyer's agent. We're committed to the education of both first-time and seasoned investors in property investment and wealth creation. The Passive with Property podcast is brought to you by the Buyers Agency Australia.
Now, Amanda, just going back, we're discussing these three strategies out of many strategies that are out there, and this is because between myself and you, we've got, years of experience, and we know what's worked best for us.
That's it. So, we've done the try before you buy for everyone.
Exactly. And this is why we offer these strategies, to our clients, because they work. They're proven strategies. We have, as you said, we have trial and error, and we prefer to, have that as an option for them.
That's it. And if people come to us and say, look, I'm not really comfortable with that, or I'm more comfortable with this, and we tailor it and we tweak it and we adjust it to suit what they want to do and what they can sleep at night with, because at the end of the day, it's their money.
Exactly.
And if they can't sleep at night, and if it's going to keep them up, stressing and freaking out and wondering, what on earth have I done? Why did I trust this guy? Then we haven't done our job, have we?
No, that's right. And I guess another thing, that's what separates us from what you call a standard buyer's agent, is we are also qualified property investment advisors.
That's it. So with that comes the training on how to strategize, not just at a sales level, because we're not just selling properties to people, we're selling a strategy. Exactly. And in order to do that, you actually need to know how to create one. And to know how to create one, you need to know how to assess the client. And to know how to assess the client, you need to understand the client. It's a whole stack of dominoes.
Yeah.
And without your own buy-in as an investor, without having walked the walk yourself, how can you send someone else on a path that you yourself haven't walked? It doesn't make sense.
Exactly. Yeah. All right, so let's start on the first strategy, buy and hold.
Okay, so what I want to do before we launch into buy and hold is actually just show what the three are. So, people that are listening can orient themselves within the larger framework here. So you mentioned buy and hold as the first strategy, and that's the most conservative of the three, because what buy and hold is as the name suggests, you purchase the property, you pop it in your portfolio, you hold it there, and you forget that it exists.
Yep.
Okay?
Safe and secure for
people
with low risk.
Slow and steady, low risk. It's the way our parents and grandparents did it, because, the world was different, access to information was different, they didn't have the internet. It's a very traditional method of property investment, buy and hold. The second is probably the more trendy one at the moment, and that's what we call an equity play or a value add play. So that's where you manufacture or you force equity or growth onto a property that might not be in line with natural market growth. So buy and hold is where the market takes care of the growth for you over time. Forced equity is where it might be a flat market, but you may, renovate the property or add value to that property to force growth outside of natural market movements.
Could also be called manufactured equity.
Manufactured equity, that's right. You're engineering that yourself. And the reason that I say that is a trendy strategy at the moment is because we do have access to information now with the internet. We do have things like, renovation shows on TV. People went through a real DIY phase during COVID. We have people wanting to be a bit more hands-on and we're very project-based now as a community. I think people like taking on hobbies and projects. So things like a renovation or whatever strategy they choose within that umbrella is a labour of love for a lot of people. They want to feel that pride and that they've contributed to that. I think a lot of people also get impatient with buy and hold because it is like watching paint dry. You are buying the property, popping it away, collecting your rent, paying your mortgage, and that's it.
Yep.
It's very easy, it's very idiot-proof, it's very reliable, and it's a very good method if you have the time to ride out, 1 or 2 market cycles. But, the later people start, the more they start to look for quicker methods, and then that's when they gravitate towards that second one. The third one is a little bit more advanced. That's where we start talking about development. So whether it's small development like cutting a big block of land in half, or whether it's larger development like throwing half a dozen townhouses on a larger lot of land, development is obviously a lot more risky, high risk, high reward. It requires a lot more capital, so it tends to happen later on in people's investment journeys. People don't tend to start with development. They tend to grow into development once they've cut their teeth on the other 2 methods. So I want to sort of discuss all 3 of those today and what goes into deciding which method is best for a particular client, taking into account their risk profile. So you mentioned earlier, buy and hold is really good for those that don't like risk. Simply because there's no interference required. You don't have to interfere with the property with a renovation. When you interfere with a property, such as with a renovation, you're removing your source of income because your renters have to move out while you're renovating. You are throwing more money at the property, so you have the risk of overcapitalising, spending more money on the property than the property is worth. You have the risk of budget blowouts, time blowouts. So the more you interfere with a property, the more risk you carry.
Yeah, that's right.
Whereas with buy and hold, you eliminate that by buying well. And that's where you come in, by buying well. So with a buy and hold, what do you look for when buying well?
Well, we'll look for under market value properties, off market properties that,
Yeah, so that first one, you hit the nail on the head, under market properties, right? So you make your money before you've even settled.
That's right.
If you're purchasing under market. So for people that don't understand what under market means, how do you know if a property is under market value?
Well, you do your due diligence on what recently sold in the area for a property that's very similar to what you're looking at.
Yeah, so you're looking at comparables. You might buy something that's a little bit run down. It might be a deceased estate, for example. So say, somebody elderly has passed away and all the kids are living out of area. None of the kids are available to travel to clean up, mum and dad's property. They're happy to sell it as is for a discount. Someone like you might be happy to come in, clean it up and, you've saved yourself 30, 40, 50K. It might be, I always love hoarders' houses. They don't want to clean their place up either because for them, time is money, right? So if they sell the place at a discount, that's no different to paying someone else to clean it up.
And you got to see the value. Most people walk into a hoarder's house, and they'll say, "Oh, geez, I'm not paying." They won't even. It's
not marketable.
A slightly under market value. They just, they just run away from it. Where someone else who's got an eye for it, they'll go, well, I know this property's worth that much because recently sold. I'll just, clean it up a little bit and then there's my profit.
And that's
just
what a
on
good
the
investor
purchase.
does, right? A good investor sees the diamond in the rough. Yeah. So a good investor might look at a 3-bedroom property and go, you know what? There's a superfluous living area here that I can turn into a 4th bedroom.
Yeah.
They don't just look at something. You've got something to say.
No,
you just lit up there. You got a story?
No, I don't. No, you continue on.
I was just going to say it's seeing the potential in a property as well, not just looking at the way that it's marketed, but seeing the diamond in the rough and seeing where you can build opportunity that others may miss.
Exactly. So it was funny because I was just with a client yesterday and they asked me, okay, I think I see potential. What do you see? And I said, well, you see this living room. There's a smaller living room, a second living room that can be turned. You spend a few $1,000s, get someone just to put up, or you're not renovating.
Yeah.
And suddenly you're profiting 50, 60, 70K. Because it's now a 4th bedroom and all the 4 bedrooms within the area recently in the last couple of months sold for this amount. And he's like, oh, wow, yes, I can see that now.
Mind's blown.
Yeah.
And then when you compound all the different opportunities there, right? So say you've purchased something $30,000 or $40,000 below market value, and then you've made $50,000 or $60,000 by adding a fourth bedroom. Right. Suddenly you've got $100,000 in equity. That's already another deposit.
That's right.
And you're ready to rock and roll again.
Yep, exactly. Yep.
Yeah.
And there's minimal it's not even a renovation.
No,
it's
you're
just
chucking a wall up. No
up.
council approval required. It's
That's
internal.
Yep.
Yeah. And from a rental perspective as well, your cash flow increases because that fourth bedroom is worth more.
Exactly.
Yeah.
Yep.
So it's little things like that aren't really too complex for investors. They're just things that investors miss because they don't have the experience to go, well, that's the best way to do this. Yeah. Whereas someone like you or I could go, hey, you know what, that's a good property there, but next door actually, even though it's right next door, has more potential.
Yeah. Yeah.
So it's not just picking the hotspot suburbs, it's also picking the diamonds in the rough within those high growth areas.
Exactly. Yeah.
Yeah. So that's your first strategy, buy and hold. And we sort of touched a little bit on equity growth there by adding the fourth bedroom, but I would argue that you're still in that buy and hold.
I think you own that first day. Buy and hold.
Because
it's not a reno.
It's not.
What's the risk in that? Zero.
And once it's done, you collect your rent. And the idea is as well, you want to attract long-term tenants so that you can forget about that property.
Yeah, exactly.
You don't want high turnover with your tenants. So being a good landlord is really important. I think a lot of landlords forget the importance of being a good landlord because you want your tenants to stay. You don't want the turnover. Yeah. You know, people say, if they live there for 10 years, they'll trash the place. But you know what? It would have been due for renovation anyway. Yeah. So leave the one family in there if they're happy. Yeah. I always say, people are scared of pets and kids. I go, that's great because they're in a school zone that, you need 13 years of schooling. Yeah. Leave them there. Yeah. You want people with kids. The younger the kids, the better. They'll be there longer.
It's harder for them to leave.
That's right.
Yeah.
Whereas
not only because of the family situation, but also because of financials as well.
Correct.
It's not cheap moving.
No. Whereas for me, a young couple, people go, oh, two young professionals, they won't trash the place. Cool, but they could break up, be relocated for work. Yeah. They could upgrade, choose some of it, their incomes are likely to increase, so they're going to want to upgrade into a nicer property. For me, I would much rather a family with two big dogs renting and staying put than having new tenants every 6 months and having to make improvements to the property to make it rentable in that time.
So, Amanda, we've discussed equity. Now we're going to get into the second strategy being cash flow.
Within the buy and hold.
That's right.
Yeah. So we talked about how, you could add on the fourth bedroom and all of that to get your little bit of equity there without having to undertake an entire reno. The other thing you can do is just go hard on the cash flow angle. Yeah. So again,
it's one of my favourite strategies.
It is one of your favourite strategies because you like chasing your cash flow for clients, which is what they want, right? Yeah. People invest to make money. So another way to do that is through co-living. And since this is your favourite topic, why don't you tell us about it?
Well, look, co-living is actually when you rent the rooms out individually in a house. So you would furnish the place. Now, these days you actually have specialty property managers who actually do it all for you. So they will actually order the furniture, furnish the place out for you, connect the NBN, pretty much look after everything, advertise the tenants. Now, a lot of people are thinking, oh, well, what if tenants, come in and out, on a monthly basis? So these days with a co-living, individual tenants are on a 6-month or a 12-month lease. They pay bond. So it's pretty secure. But you're looking at, 8, 9, 10% returns on the rental yield. So this is why it's my favorite. So what it is, we're purchasing properties, for instance, let's say Brisbane. You're in a capital city within that catchment of 40 k's of radius of the CBD. You're paying at today's value of, say, 700, 720, and you're getting 900, 1,000, even up to, $1,100 per week on that rental yield.
Yeah, and if the interest rate's at, say, 6%, to be returning 9 or 10%, you're well and truly above your interest rate, aren't you?
Exactly, yeah.
So you're covering all of your expenses.
That's right. Now, obviously, you have to have an understanding of where you're purchasing because not all co-living works all over, in certain areas. You need to position yourself in more of the high demand areas. So that would be near universities, hospitals, near the shopping precincts, things like that. So, yeah.
So it's knowing where to deploy certain strategies as well.
Exactly. Of course, yeah.
But then the return on that would be, obviously the reward is the cash flow.
Exactly.
Because that kind of return is unheard of, 9%.
Yep. And look, there's a few more moving parts to that strategy. A few more costs, obviously, with the furnishing. The property management fees slightly higher.
Yeah.
You have by law, for instance, in Queensland, the landlord needs to provide NBN to the tenants. But still, even after all those costs, it's worthwhile, definitely.
Yeah, for sure.
And it doesn't hurt the pocket.
Well, that's it. The whole idea of buy and hold is that you can forget about the property. So if the property is self-sustaining and covering all of its own costs, you can quite literally forget that it exists, leave the property manager to handle everything that needs to be handled.
Yeah.
All of your expenses are covered and you just forget that it's there and collect your equity when the time comes.
Exactly.
That's the beauty of it. Yeah, and I think that's why the buy and hold strategies are really good for investors with low risk appetites, because the less input out of their own pocket that is required, the more hands off the investment is. Then it just becomes a matter of waiting for a boom, 30-40% equity.
Yeah.
Haven't had to lift a finger, haven't had to spend a cent outside of that initial deposit.
That's right. That's right.
It's a great strategy.
Yeah, and look, some people are going to turn around and say, "Oh, but I have to deal with four tenants." And I said, "Well, are you planning to have 4 houses?"
Well, not only that, it's the property manager as well.
Well, it's a property manager who looks after everything. If you're having to deal with,
See, I would counter-argue that, just to throw a spanner in those works. If you've got 4 tenants across, the 4 bedrooms in a co-living arrangement, if one tenant moves out, you've still got the other 3 paying their rent, right?
Exactly.
If I've got 4 houses and 4 mortgages and one of those tenants moves out, I've got one mortgage completely neglected, essentially.
Amanda, what I tell my clients who are looking at doing this strategy but they're unsure of, I actually tell them, well, look, it's actually a stepping stone from having one house to a few, because you're still dealing with many tenants but one house.
Yeah.
So it's
one mortgage.
And one mortgage. So it's a gradual step.
Yeah.
Instead of going from one house to 2-3 houses, you're going from one house with a few tenants, and then 2 houses.
And the odds of it being completely unoccupied, all 4 bedrooms being empty, would be quite low.
I've never experienced it.
So you've always got that mortgage being supplemented by tenants, as opposed to a property that's completely vacant for weeks. Yeah.
Exactly.
So it's very low risk, very hands off.
Yeah. I've been doing this strategy myself personally for many years.
Yeah.
And if I could go back to my 20-something-year-old self, I would be definitely pushing him into this. Yeah. 100%.
Because that higher cash flow helps save for the next deposit.
Exactly.
Quicker, you've got all that equity. Yep. Yeah, for sure. Well, that's good for beginning investors, for people that want the cash flow, for people that don't want the risk of having to pay a portion of that mortgage or expenses out of pocket.
Yep.
So definitely buy and hold has its place.
Yeah.
In the investment portfolio, but we do have other strategies too.
We certainly do, and that's the uplift, the manufactured strategy.
The manufactured
strategy
equity.
3.
So I know you love your buy and holds and your co-living. I'm probably more leaning myself into these types of projects. Probably because I get bored of buy and hold, and maybe that's my personality type. Yeah. But I've often said to friends and family when they come to me for investment advice, I go, look, if you're just doing buy and hold, that's great, but it's like watching paint dry. Yeah. And if you have fun watching paint dry, that's awesome. But unless you're happy to literally set and forget and be hands off, and property is not something that you transact in and out of like the share market. It's quite literally buy well, leave it. Yeah. Then property is a great investment vehicle. But for people that like to be a little bit more hands-on and do have a higher risk appetite, like me, the equity plays can be the way to go. So equity plays, they become buy and holds once you've done interfering, as I call it, with them, with your renovations and whatnot. But this is when you buy the real diamonds in the rough. This is where you really have to create opportunity. And what I like about it is that these types of purchases allow you to make money in any market, not just a growing market. And this is a real beef that I have. And if you'll allow me to detour just for a moment and indulge myself in my own opinion, this is where I wonder in the next few years what's going to happen, right? Because we've just come off a big, huge boom in 2016. And then if you recall, 2018, 2019 markets were quite flat. The property market was really struggling. And then 2020, COVID hit. We had all that government stimulus being pumped into the economy. And when you have that much money being pumped into the economy, there's a saying, I won't say it in Italian, but to translate it, there's a saying that money dies in property because people take that money out of circulation, they save it, they invest it. Where do they invest it? In property.
That's right, yeah.
So you always have big, massive property booms right after you have huge amounts of government stimulus. So anyone that was really smart, once they saw the government intervening during COVID, they bought property because they know that money dies in property.
Yeah. Safety.
100%. Yeah. Money dies in property. There's always a big property boom after huge government investment and people, being given money.
Yep.
So this is where I get a bit of a bee in my bonnet, right? So we've had a 2016 boom, we've had a 2021 boom, and the industry for buyers agents sort of had its run up through both of those booms, right? Prior to 2016, buyers agents were quite rare. Mm-hmm. Many people didn't really use them, or if they did, they were more of a niche type of service.
Yeah.
Whereas now I think buyers agents have earned their place in the market and a lot of buyers want to be represented, which is smart and wise. The vendor is represented, the buyer should be represented too.
You don't go to court without a lawyer.
You don't go to court without a lawyer. So it's the same thing, right? Buyers agents have earned their place in the market. But what I find interesting, particularly with buyers agents that specialise in investment properties, they've never actually had to operate their business during a flat market. They've only ever had growth markets and back-to-back booms.
Yes.
So a lot of these
an easy sell.
Well, this is the thing, right? My metaphor is if you're buying in markets where you could throw a dart and no matter where that dart hits, you're going to get growth.
That's right, yes.
Well, anyone can make money. Any buyer's agent can look good because the market did the work for them.
That's right.
Okay. So now I think we've had two back-to-back booms. The next boom is likely going to be years away. So how are people that have never invested outside of a boom going to know what to do in a flat market? Yep. So these equity plays that we're about to talk about, these are the way to do it. But how many buyers agents are actually
doing that,
pushing these strategies? Yep. Because a lot of buyers agents rely on, well, I'm going to sell house and land packages because I get guaranteed stock from the developer, or I'm going to push people into, I'm going to use my previous, we bought in this suburb and it grew this much, so you can trust us to buy in that suburb because we got it right before. But everyone got it right
everyone
before.
Got it in the last
you know what
years,
I mean?
Yeah.
And it really bothers me. Yeah. When I hear some buyers agents talk about, for example, hotspots.
Oh, man.
Because I go, you roll your eyes a bit because you go, okay, hotspots in a flat market. What is that? What does that mean?
Well, it's one of these, I use when I get clients or people who are about to become clients and they said, oh, are you guys looking at hotspots? And I always give them the example, I can give you hotspots and that will perform 30% in the next 24 months. Or if you're looking to do this long term, as that's why you came to us, would you prefer if we just took the national rate of 7% growth compounded over 8 years, 7 years?
Yeah.
Which one would you take?
That's
and
right.
They're like, oh, yeah, I get it now.
Yeah.
So
I think
hotspots are a marketing tactic.
They are, and I think a lot of people have the view, when I collect my 30%, I'll sell it, but they don't factor in transaction costs.
That's right, yeah.
Property is, at its essence, even though we talked about buy and hold as the first strategy, at its essence, all of the strategies boil down back to that. They're just different paths to the same end.
And it's one of those things that, there's going to be a lot of people that are getting angry. The typical Perth.
Everyone asks about Perth.
Everyone asks about Perth and go, oh, my friend did well in the last, everything, as you said, Amanda, everything went well in the last 3 years.
Everything in Australia is on the east coast. If you go to the west coast, you're going there for mining, which is work, which is cyclical, which is subject to boom and bust.
And look, people who live in Perth, and if that's your choice of lifestyle, that's fine.
But that influx of immigration isn't happening in Perth.
That's right. And it all happens in New South Wales, Victoria and Queensland. 99% of immigrants
And this is what I
to-
don't get, right? Because these same investors, and I mentioned immigrants just a moment ago, these same investors accept that our property market is inflated because of immigrants,
Yes.
but then they use Perth as a hotspot where the immigrants aren't anything. You're contradicting yourself
That's
out the
right.
gate.
Yep.
And you think, are you just absorbing media garbage? And
No,
thinking,
I'll tell you what it is.
please tell me.
It's an easy sell. What I mean by that is people pushing Perth. Now, think about it this way. I'm going to advertise my business. I'm going to say, hey, look, we can buy you a house that's $600,000 and get you $650 rent. Wow, it's a capital city. It's Perth. How easy is that sell? That's, a 5.5, even if it's a 6% return, that sounds great. It's an easy sell. Then someone like us going, well, look, it's not going to be the best rental return. There's ways we can through co-living and all that sort of stuff. But
if you're chasing the cash flow.
If you're chasing the cash flow. But your growth is definitely going to outperform any other, city. Long term.
The rent is how you maintain the mortgage, right? But the growth has to be in the equity because all your rent is doing is just keeping your holding costs at bay. But there's got to be growth. Otherwise, what's the point?
Yep.
You're just treading water.
Yeah, there you go.
So that brings us to the equity, right?
Anyway, yes, we veered off.
I veered off because I get angry at, or not get angry, but I feel like there's a lot of investors in the market that have never invested in a flat market. The market's always forgiven their mistakes. If we look at the last 10 years, you could make almost any mistake in the book and the market would have forgiven it. You could have overpaid. You could have paid badly, paid too much for a reno, whatever. The market grew enough to cover your mistake.
Yeah.
So I think a lot of buyers agents and a lot of investors maybe misattributed the credit to their success to the buyer's agent or to their investment expertise when it was just basic market movements. And I always say to people, did you outperform the market? Because if you did a renovation and you did all that interference and threw extra money at something and you made 20%, but the market grew 30%, you actually underperformed the market. You still spent too much and you still got it wrong because you could have done nothing and made you 30%, but you interfered with the property, spent money on it and only made 20%. But you're telling everyone you made 20% when everyone else who did nothing made 30%. So this equity thing, and I want to talk about it just a little bit more in detail because I refer to it as interference on purpose. And I deliberately choose a word with a negative connotation, interference, as opposed to property improvement. I call it property interference because the interference is where the risk is. And the interference is where the risk of negative growth is. So I said before that a growing market has forgiven a lot of people's mistakes, where they still made money, even if they made the mistakes because the market outpaced their mistake.
Yep.
Okay? In a flat market where everyone's on a level playing field and there's no growth and there's no market to forgive you, there's no growth in the market to forgive your mistakes, can you outperform the market? Yep. So with a renovation, we talk about equity. So this is the full renovation, not just the fourth bedroom or the co-living, This is where you might gut the whole place, open up the living areas, new kitchens, new bathrooms, everything.
Now, before you continue, sorry, I'm going to throw in, please explain to the listeners, there's a difference between cosmetic and structural renovation.
There is a difference, yes. Okay, so cosmetic renovation is where you are updating the aesthetics of a property. Yeah. So that might be new carpet, new paint. Yeah. It's where you're not interfering with the bones of a property.
That's right. Now, you can strip the kitchen, the tiles.
That's right. So any kind of fixtures, so kitchens, bathrooms, so fixtures and aesthetics would be considered a cosmetic renovation.
And there's no actual approvals needed by council.
No, because it's all internal.
That's right, yep.
Whereas a structural renovation is when you are changing the bones of a property. So a structural renovation will be something like you've added on an extension, so external additions to the property. You might be adding on an extension. You might be rearranging the floor plan. So if you're moving, for example, plumbing, you've decided to turn the laundry into a butler's pantry and then, build a new laundry somewhere else. You're changing the plumbing. That would be a structural renovation. You might add a second story. Yep. That would be a structural renovation. So anything where you're actually changing the underlying asset. And in those instances, things like your insurances, your lender might want to know because you are changing the underlying asset. Sometimes you'll have to go through council to get approval depending on what you're getting done. Adding on a carport, adding on a veranda, whatever it may be. There are certain obviously regulations that you need to be mindful of as opposed to a cosmetic reno. But in both instances, the goal is to increase the value of the property. Now, with that comes a risk assessment, right? You have to work out, well, what amount of money can I spend on this property to ensure that I don't overspend to the point where I've spent more than the property is worth? And this is where people get their numbers wrong, okay? Because they might buy a property for, say, $600,000 and go, okay, I'm going to do a $50,000 renovation. But they don't factor in, not only have they spent $50,000 on the renovation, but they've also forfeited rent money, which then becomes a cost. They're paying out of pocket for the mortgage, so they've got holding costs, so their interest and so on. They've got holding costs. So a lot of people tend to forget or neglect to do accurate numbers because it feels nicer when they think they've had a win. So they'll manufacture their numbers instead of manufacturing their equity. So this is why I use the negative connotation, the word interfere, because interfering with the property, you need to be really confident that what you're doing is worthwhile, because sometimes buy and hold and doing nothing actually yields the better result. So when we say look for the diamonds in the rough, you've really got to be able to run an assessment on that property and give yourself multiple options. Okay, if I just do paint and carpet, that might cost me $5,000. The property will be worth $25,000 more. That's probably worth it. Whereas if I'm doing a full, gut and reno, new bathrooms, new kitchen, new everything, I'm spending $150,000, but the property's only going to be worth $100,000 more. And I spent $150,000 on reno and then more than that on holding costs and lost rent, not worth it.
That's right.
So this is why I talked about earlier where the market can forgive some mistakes if the market goes up, but then you've taken on the headaches, the stress, the risk and so on for very little gain when you could have done the first strategy, buy and hold, bought well, done nothing, and still made the same money. Now, there is a bit of an insurance policy here. Again, if you use a buyer's agent that knows how to negotiate, where we call making your money on the way in. So this is where you buy below market value. So say the property is worth $650,000, you get a, whiz-bang buyer's agent like yourself to pick it up for $50,000 below market value. That then becomes your renovation budget because what you've got is $50,000 on the way in that you've already got equity on. So you're not losing anything on that property until that $50,000 is used up. So the rule of thumb that I always use is whatever I buy under market value for, I then spend that amount of money to improve the value of the property, then the equity I've got is free, essentially, because instead of spending that money at purchase, I spent that money post-purchase.
That's right.
To improve the purchase.
Now, I'm sure there's plenty of people out there that are asking, well, how can I do that? That's going to be another podcast later.
Yeah, how do I actually get these discounts?
Discounted properties, and that's right.
We'll share those secrets all in good time.
We will.
But, of course, if you want those secrets early, you can always book a call in with Dragan.
That's right. Link below, guys.
And
feel free.
Get those secrets ahead of time. But that's really the crux of these equity plays, because you want to make money on the way in and then force more growth once you own the property, especially if the market is flat. Because to get into your next property, you don't want to just rely on savings and saving manually for your next deposit. You want to be able to use the equity in your existing properties to fund your next deposit. So to do that, you have to force growth. And I'm really curious to see how other buyers agency businesses pivot into the market we're heading into when they can't rely on the market growth to do the work for them. And even investors, not just buyers agents. I think there's a lot of investors that are getting a little bit big for their boots and going, oh, well, I made this much money and I'll keep, and they get a bit cocky, and all it takes is one mistake. And one mistake can be quite costly.
We've seen with some clients,
Yeah.
So, okay, so we've got obviously the method you've been discussing, but there's further to that. For instance,
to grow equity.
To grow equity, yes.
For sure. There's so many things. I mean, I could sit here all day.
Just one other example.
You could do granny flats.
Yep.
You could knock down rebuild. I'll just give you a list. We won't get into each one. But granny flats are good, knock down rebuilds. I love corner blocks because you can always do something on the side street, whether it is a granny flat or even a shed, whatever.
Yeah, separate side entrances
Privacy,
and all that. Yeah, for sure.
Some people like to land bank. I think you've got to have pretty deep pockets for that, but that's another one.
There's a way of land banking.
Tell me.
Okay, where you can purchase the property on a large block, So one of my favorites is have that place, for instance, co-living. It sits on a 1,200 square metre block. Then you can wait it out. You're still getting the...
Oh, here I am talking about land banking 50 acres out near.
Oh, right. No. I'm talking about
in metro areas.
In metro areas, yeah. Where you do purchase that house that has 4 bedrooms, you put co-living, set it up as co-living.
Oh, and then you mean down the track.
And then down the track, you can then, obviously you've done the research on knowing how to if it's a potential subdivision.
That's right, you do it later.
So we have clients that are out there that say, oh, you know what, I love the idea, but I'm scared of doing anything now. We say, well, why don't you go into the option of purchasing the house, having it co-living, so you've got that high rental,
you've got your cash flow
coming in, and just sit on it and let the equity grow year by year, so that works as a buffer.
Yeah.
Then 5 years, 6 years down the track, then
it funds its own build.
That's right, it funds it. So then pull the equity from that, build the granny flat on that. You won't have to worry about cash flow because you've got that cash flow coming in from the house at the front. Or you build another 4-bedroom house, this time with en suites, that you can then co-live again.
Yeah.
Okay. So suddenly you've got a massive rental income coming in. You've put equity on top.
Yep.
Instead of going off and buying another $800,000 or $900,000 4-bedroom property in that area, you've spent $500K, but got the value of,
And you've minimised the risk of that interference because you're not actually kicking your tenants out. You're still collecting the rent on the first house while you build the second house.
Correct.
Yeah, it's perfect. And this is why I personally quite like the equity method, right? Because as you said, you can do it at any point in time. So you can start with it as a cash flow buy and hold, but if you look at properties with potential, they can convert into equity plays later because you've bought diamonds in the rough with untapped potential. Yeah. And this is why we as buyers agents avoid, for example, house and land packages where you're buying something brand new because all of that equity is already done. It's already unlocked. It's already done. It's brand new. It's already at the top of its growth cycle. There's nothing more to be done, which means there's no more growth to be had until the market does it for you. And that could be years away. Yeah. So as investors, I think investors need to get a little bit smarter now about how to actually force equity and manufacture equity and make sure there is growth in their properties because we can't always rely on the market because the market doesn't always run to the time that we want. If we want to retire in 10 years instead of 20, well, some of these fast-track methods can help achieve that.
That's right.
Which brings us to the fastest track method, which is development.
Developments, that's right.
Yeah. So there's different scales, I suppose, of development. You can go really small with just, basic subdivision, cut a block in half or put a duplex or a triplex or a knockdown rebuild. Or you can go all out and, put a dozen townhouses on something. People can go as high or as low as they like. We are starting to come into things like commercial finance here, depending on the size of the project. But if we keep it residential, up to 4 dwellings.
Just so the audience knows, the listeners out there understand that you're also educated in property developments. And it's not just by experience, but Amanda, maybe you want to explain to them?
Yes. I wasn't going to bring this up myself, but during COVID, a lot of industries, stood still, and I was a teacher before this. If you've listened to our other podcasts, you'll know that I was raised to never make a hobby a day job. So for me, property investing was always on the side, and I was a teacher. And then I had my babies, I stopped teaching, and then COVID hit, and going back into teaching in that COVID environment just didn't interest me at all. So at the time, one of my friends was doing her MBA because everything was work from home. So she goes, instead of commuting 4 days a week, I'm going to do my MBA. And I said, I might join you at uni. I might do a master's in property development. She looks at me and she goes, you're a teacher. Why are you doing a master's? And I go, I had something to do, COVID. I'm home alone with babies all day. Like, why not? And at the time, the unis had lost all their international students, so they were accepting anybody. So, you have to write a letter. Why should you do a master's in this?
You're in.
Pretty much. I was like, look, I've got personal experience. I was honest. I'm like, I've got personal experience, but not professional experience. But I want to pivot into that industry after COVID, and I need a qualification. I need some sort of backing because I can't just go do everything by my gut. I mean, I've got to have something to back myself. So, almost finished my master's in property development, and it's quite interesting because everything I've learned by doing. So then to see the theory and the academic behind it and go, oh, so they've just formalized what I've always known, or they've just put into formal terms what I've always done. So they'll, talk about, oh, this is how you do a proper feasibility, and they throw all these formulae and mathematicals, and you got to sit there, and you go, oh yeah, that's good. And then you sort of look at it practically, and I've always done things by the back of the envelope, and I go, it's the same thing.
Yeah.
But it's just really interesting seeing the academic side of it, because you can weigh it. We always talk about people being book smart and people being street smart. And I think there's real merit to having both, because you can know all of the theory in the world and be an absolute legend at all of that.
But universities,
but you've got to walk the walk.
You've got to walk the walk. But universities are also designed for them to get you ready for the corporate world.
That's right.
So you need that side of it.
You need that backing as well, because you've got to be able to communicate, in our case, to clients what they're doing, right? If you go to a client and you say, oh, trust me, I know what I'm doing, their first question is going to be, why?
Yeah.
What backing do you? And you can say, well, I've done it myself. And this is the thing, a lot of my investments, and this is what I've said to you before, and in terms of other buyer's agents, you can have a sales background, like you could be an ex-real estate agent that's become a buyer's agent, and your background could be in sales. But unless you're actually an active and engaged investor yourself, you'll never understand the emotional journey, the thought process, the risk, the things that keep an investor up at night. When you get that phone call from your property manager, oh, your bathroom's flooded, what do you want me to do about it? Or, there's always something where you have to make a decision on the spot.
Yes.
And once a buyer's agent that's only ever been a salesman has sold your property, they don't really understand the rest of it. So for me, being an investor and having done some small developments and then going to uni and learning the client side of it, and okay, well, when you speak to a client or when you deal with a builder or when you do this or when you do that, this is why you're doing it. It actually gives it a bit more meaning than, flying by the seat of your pants because, dad said this was a good idea. Yeah. So I think for me, doing the degree, whilst it started, I called it a vanity degree when I started it. It started as a vanity degree, but it's actually really proved its worth because it's formalised a lot of things that I was doing anyway, but put them into a framework that gave me a more grounded understanding.
Okay.
Yeah.
Amazing.
Yeah.
Cool. There you go. You guys heard Amanda's experience.
Yeah. Look, nothing replaces doing. I think you've got to complement both. There's no point being only book smart or only street smart. You've got to have both because one reinforces the other. That's
right. I agree. I agree.
So that's the third strategy, development, which tends to be a more advanced strategy that people grow into.
Yeah.
As their portfolios grow.
Okay, guys, thank you very much, Amanda. That was quite informative. Thank you.
Thank you for having me.
And guys, everyone out there, thank you very much. And until next time, see you then.
The Passive with Property podcast is brought to you by the Buyers Agency Australia.